How do you get the safety of an ETF, but the upside potential and the cash flow of a dividend stock? In this video, we'll compare dividend stocks versus exchange-traded funds. I'll show you the pros and cons of each and reveal two strategies to get the best of both worlds. We're talking stocks versus ETFs today on Let's Talk Money. Beat debt, make money, make your money work for you. Creating the financial future you deserve. Let's Talk Money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now Nation, one of the biggest themes here on the channel is that investing shouldn't be complicated. Now I want to make growing your money something everyone can do. Help everyone put their money to work. But picking stocks is hard. If you're trying to find that handful of stocks to produce those double-digit returns, you're spending hours digging through the financial statements, following the news, and that's all after what could be years spent understanding just how to analyze stocks. It's one of the reasons why I love exchange-traded funds or ETFs as an alternative to investing in individual stocks. You still get that potential for return, but in a way it's so much simpler and faster, but you do also have to give up some things as well. So which one is better though, investing in individual stocks or ETFs? In this video, we'll start off by looking at the differences between stocks and ETFs. We'll look at the pros and the cons of each, and then answer which one is the better investment for you. I'll also show you which is the best for dividend stocks or funds. Then I'm going to reveal two strategies to get the best of both worlds. And before we get started though, I want to open this up to the community, kind of a community question. Which do you prefer, stocks or ETFs? Now, which do you think gives you that best return, the lowest risk, and the highest cash flow for dividend investing? So just scroll down and let us know in the comments, which do you prefer and why? Some quick definitions first, and I will leave a clickable index in the video description below if you want to jump around a little bit. Now, stocks are an ownership share of a company's future earnings. Okay, instead of borrowing to fund the company, it can issue shares to investors. So you own an actual piece of that company, a piece of any dividends it returns, and in theory, a piece of all future earnings. An exchange-traded fund, or ETF for short, is a collection of stocks or other investments. The fund manager buys shares of dozens or even hundreds of stocks in a set theme, and groups them all into this one investment, and then sells shares in that group to investors. Investors get an instant ownership in all the stocks in the group and pay a fee to the fund company for management. And you can have these groups covering just about any theme of investing. You've got funds that invest in sectors like the Utility Select Sector SPDR, that's ticker XLU, which holds shares of 28 companies in the utility sector. You've got the ProShares S&P Dividend Aristocrats ETF, ticker NOBL, which holds shares of 64 companies that have increased their dividends for over 25 years or more. And the stocks held in these funds might stay pretty much the same, as is the case with those sector funds, or they might change from year to year, like that Aristocrats fund, adding and dropping stocks depending on that 25-year dividend criteria. The pros of investing in individual stocks so that you get complete control over your portfolio. You know exactly the companies that you've got shares in, and you can buy or sell those anytime you want. You just can't control what stocks the fund manager is going to put into that ETF. Stock investing is also a little easier to analyze. And I say that maybe with air quotes, okay? Some ETFs hold hundreds of stocks, so being able to analyze each company and then come to a fair value for the whole fund itself is pretty much impossible. While it is much easier to analyze that single stock, that still doesn't mean it's exactly easy. For the most part, you also get a higher dividend yield with the individual stocks. Now, sure, some of those funds offer some great cash yields, but the overall yield, that's always going to be a balance between the high-paying dividend stocks and those paying less. With individual stocks, you can go after the single best dividend in that group. And the same idea here applies to that return. You can find some funds with great returns, but it's always going to be that balance between the winners and the losers in the ETF. So generally, individual stocks are going to give you that potential for higher return. Now, the biggest drawback to investing in individual stocks is just going to be that headline risk around that company. Even the best analysts can be caught with their ass out, wrong about a company's value, or just blindsided by some company news that takes it lower. While the ability to analyze a single stock might be a pro, the time it takes can also be a negative. Now understand, I'm not saying you don't need to do an analysis on an ETF. You need to do that higher level analysis though on the theme or the sector, looking at those economic trends and the market forces that could benefit the entire group of stocks. For example, I can look at rock bottom interest rates and know that it's going to be damn near impossible for lending banks to make money, so maybe I'd avoid a regional banking ETF. So there is some analysis that goes into investing in ETFs, but it's not nearly as time intensive as digging into those financial statements of a stock, creating the cash flow model to forecast earnings per share and everything else that goes into good stock analysis. Now this last difference or drawback is more of a psychological thing, and it's something that I've noticed in myself as well as other investors. When people invest in stocks, they'll watch those buggers every single day. They'll check the stock prices online. They'll lose sleep when a stock falls. And God forbid the stock rises, because then they pull their hair out trying to decide when to sell. Investors just don't seem to get as worked up over ETF investments. Sure, it still hurts when that ETF falls, but there's not much news on the funds themselves, and the price movements are usually smoother than that risk in stocks. ETFs just seem like more of a set it and forget it investment for a lot of people. A lot of the pros and cons of investing in an ETF then are going to be the other side of that coin. The upside is you get that instant diversification across all the stocks in the fund. You don't have to worry too much if XL Energy falls, because it's only 4% of the Spider Select Utilities Fund. Again, these tend to cause less stress and market watching than those individual stocks. You've got those shares in Apple and Microsoft in the Spider Tech ETF, but they're just such a small part of the fund, and you don't feel compelled to be glued to the news on the companies. What I really like about ETF investing is that it frees you up to invest in what you know and then spend the time and analysis in that area. Listen, I know about as much about pharmaceuticals as I do about basket weaving, which is saying next to nothing. So instead of trying to spend hours analyzing an industry that I know nothing about, I can just use something like the iShares Pharmaceuticals ETF, get my exposure to that entire group if I think it could benefit from those larger forces, and then spend the time analyzing those few industries that I know something about. ETFs aren't all rainbows and unicorns either, though. The biggest downside here is the fee charged on the assets, and this can range from as low as 0.05% to a whole percent and more. Now, 0.1% fee probably isn't that bad. That's just going to be $10 a year on every $10,000 you've got invested in the fund. But when you start getting into those funds with a 0.5% fee and even higher, that's going to add up over 20 years. And besides those fees, the second most common complaint I hear about funds is a byproduct of that diversification. So yeah, ETFs aren't going to fall as fast as individual stocks in a crash because you're always going to have those winners balancing out the losers. By the same token, though, those funds aren't going to rise as fast as individual stocks because you're always going to have a few laggards holding back the runners. Another drawback here is that you can have a lot of duplication in these funds. So if you own the iShares Dividend Aristocrats Fund, the Consumer Staples Sector ETF, and the NASDAQ Retail Fund, you've got shares of Walmart in all three of those, so you might end up being more exposed to that company-specific problems than you thought. You can also have this overexposure problem at that sector level. So for example, I know a lot of investors own the Spider S&P 500 fund, that's ticker SPY, and think that they're good to go with a fund that pretty much covers the broad market. The problem is how this fund and the index is constructed, how much is in each sector. If you look at the sector weightings here, you've got more than 25% in tech stocks, and just 4 sectors here are 62% of the fund. So you've got almost all your investment in just a few sectors of the economy, and almost nothing in many of these others. Now, most investors don't know that, and they pair this S&P fund with maybe a tech fund or some tech stocks. And then they wonder why their portfolio is absolutely crushed in a market crash. So now we've seen the pros and cons of stocks versus ETFs. And next, I'm going to show you 2 strategies to really get the best of both worlds. But first, which is better for dividend investing? And I've really got to give the win to those individual dividend stocks on this one. The problem with funds is they don't provide much of a cash yield, even those dividend funds out there. For example, that Dividend Aristocrats fund pays a yield of just 2.1%, which is not much above the market average, even though it has some stocks that it holds pay much higher yields. Stocks like AT&T, which pays a 7% yield, and Exxon, which pays a 9% dividend yield. Now, with those individual stocks, you've still got to watch for those dividend cuts and the company-specific problems, but I've got a way to lower those risks in these next 2 strategies. Our first strategy to get that upside of both stocks and funds is to create your own fund. Now, I'm not suggesting you buy hundreds of stocks that you'd have in that ETF, but you can get that same level of diversification with just 10 or 20 stocks in a theme. Now, this is kind of what Warren Buffett does with his Berkshire Hathaway holdings. Buffett has come out publicly against diversification, but owns shares of 14 financial companies, which really gives him a fairly diverse group of holdings in the space. So while it's not the 66 companies held in the Financial Select Sector SPDR ETF, that's ticker XLF, holding that many companies does give Buffett both diversification across the sector, but also a chance for that upside potential on picking the very best stocks in the group. Not only that though, but holding these stocks directly instead of through a fund means you don't pay that expense fee every single year. We looked at how many stocks you should own in a video a couple of months ago, and the research on diversification says right around 20 to 40 stocks is all you need to really smooth out your portfolio from those company-specific risks. This means instead of buying 2 or maybe 3 stock funds, you could buy maybe 10 stocks held in each. So pick your 10 favorite out of each fund, and that's going to give you about 30 plus stocks, the diversification and the safety you need, but also the upside potential in each and no fees. The second strategy here, and everyone in the Bowtie Nation is going to recognize this one, is the core satellite strategy. The strategy is called core satellite because you have a core of investments that make up maybe between 60 to 70% of your portfolio. Now, these are in exchange-traded funds or other funds that cover a group of investments. For example, you might have that 15% of your money in the Vanguard Real Estate Fund, ticker VNQ, which holds shares of companies in the real estate sector. Maybe you hold another 10% of your money in the Vanguard Long-Term Bond ETF, ticker BLV, which is going to invest in hundreds of bonds and pay a 3.3% dividend. Finally, maybe you hold the other 50% of your portfolio in a few funds like the ProShares S&P 500 Dividend Aristocrats ETF, ticker NOBL. So by investing most of your money, that core 60 to 75% in these 3 to 5 funds, you get that instant diversification across stocks, bonds, and real estate. Your money is spread out across hundreds of stocks. You've got bonds in the bond fund and that cash flow from the real estate fund. Then with the satellite portion of your portfolio, that remaining 25% or so of your money, you invest in those individual companies that you really think can produce those higher returns. And this is where you get in touch with your inner Warren Buffett for picking stocks and really getting those higher returns. You're following trends in the market. You're digging into the financial statements and finding those companies with a competitive advantage and underappreciated shares. The beauty of this core satellite strategy, though, is that because you only have that 25% of your money to invest in these individual stocks, and say you invest maybe 3 to 5% of that in each, that means you're only picking maybe 8 to 10 individual stocks. So instead of having to find 20 or 30 stocks, doing the hours of analysis on each and keeping up to date with each one, you only need a handful of winners. Now this is going to cut in half the amount of time you spend looking for stocks to buy and then following your investments. You really don't have to worry about those 3 to 5 funds you hold. They're diversified across that group of stocks, bonds, and real estate. So you're probably going to get more like the industry average or the average return on your investment there. Part of making money in stocks is not losing it. So check out the video on the right for the 5 biggest investment scams that could destroy your portfolio. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.